Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. Today we're taking a look at 3 stocks to consider buying right now for 2022 and maybe consider holding for a really long time. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these 3 stocks to consider buying now for 2022, it's worth doing a quick little dive into the broader market to help provide context for these 3 stocks. So the NASDAQ surged last Thursday to snap back above its 50-day moving average. Once again, after being below there for several weeks, the S&P 500 climbed above that technical mountain earlier last week, and then once again notched new closing records to end the week. Those moves came ahead of the long Christmas holiday weekend, and the S&P 500 then climbed again on Monday to new records, up 1.4%, and this was the 69th closing record for the benchmark in 2021. The tech-heavy NASDAQ also climbed 1.4% on Monday, and Wall Street is expecting the continuation of the so-called Santa Claus rally heading into the early part of 2022. With that said, today, as of around midday, the Dow was up about 0.5%. The S&P 500 was hovering around neutral, and the NASDAQ was down about 0.3%. So that's what was going on today. In general, Wall Street has poured back into stocks. Once it became clear that nationwide lockdowns weren't on the table in the U.S., and that President Biden and the administration were going to be focused mostly on increasing at-home testing and helping support any possibly overburdened hospitals amid the new wave of COVID infections. Fresh data out last week, also right before Christmas, showed that consumer spending grew about 0.6% in November, and initial jobless claims remained near historic lows. U.S. consumer spending did slow compared to October's 1.4% pop, but some of that positivity was pulled forward as shoppers attempted to get ahead of holiday shopping amid supply chain worries. The bulls do now appear to be back in control for now, as Wall Street seems to have mostly shaken off those Omicron worries. Traders are now calling for, as we mentioned, new highs continuing through to the early part of 2022. Plus, we should note that some beaten down growth stocks, many of which are trading at or near new 52-week lows, are starting to be nibbled at, which is likely good news for the market heading into 2022. Since all of those stocks have been recalibrated for a year, somewhat quietly, as the strength of big mega-cap tech stocks has continued to see the 3 major U.S. indexes churn out new highs throughout the year. So with this in mind, we're going to look at some strong stocks that might be worth buying as both near-term plays for potential bounce backs in the early part of 2022 that also boast a strong track record and a business model that could make them solid longer-term holds. The first stock we're going to look at is Mastercard, which trades under the ticker MA. Mastercard is a global payments powerhouse that operates consumer and business-centric credit cards, as well as an elaborate back-end processing network. The company in recent years has also bolstered its fintech offerings, and MA is poised to make a splash in the cryptocurrency world. Mastercard is currently working to integrate and make it easier for crypto players to connect to its network. The company's cryptocurrency efforts include signing up a number of new crypto wallet providers and exchanges in Q3. Plus, it acquired in October security and fraud monitoring company that is able to help with its expertise, technologies, and insights into more than 900 cryptocurrencies. So it's slowly making some smaller cryptocurrency acquisitions. The company has also made a deal with a larger cryptocurrency company in October to help enable consumers to buy, sell, and hold cryptocurrency, deliver what they call unique crypto-centric loyalty opportunities, and streamline issuance of branded crypto debit and credit cards. So some big moves on the crypto front for Mastercard. On top of that, the company is prepared to enter the red-hot buy now, pay later space, which could be crucial going forward. After it announced recently its Mastercard installments offering. The company said that it's set to stand out in that growing market because it, quote, enables banks, lenders, fintechs, and wallets to seamlessly bring buy now, pay later solutions to consumers and merchants at scale. So that buy now, pay later space is sort of edging out credit cards for some younger consumers where they're buying things online and paying in installments. So Mastercard's trying to make sure they get in on the relative ground floor of that big buy now, pay later space, along with cryptocurrency and just more digital payments and that broader fintech revolution. MA, looking back, topped our Q3 estimates at the end of October amid solid domestic spending and a return to pre-pandemic levels in its cross-border unit, which is a lot of travel-based spending. More recently, the company on November 30th, so the end of November, announced that it raised its quarterly dividend by 11%. Investors should also be pleased to know that its board authorized an additional $8 billion share repurchase program at the same time. Mastercard revenue did take a hit last year as people cut back on spending, especially on travel. But as we just mentioned, they've seen a bounce back. So Zacks estimates call for its full year 2021 revenue to climb 23% to outpace its pre-pandemic total by $2 billion, which is a great sign as it jumps right back ahead to where it was and actually above where it was before the pandemic. It's then projected to jump another 20% in 2022 to come in at about $22.5 billion in total revenue. Meanwhile, its adjusted earnings are expected to climb by 29% this year and then 27% next year. And it has consistently topped their bottom line estimates, including an 11% average beat in the trailing 4 quarters. Even with all the positives, though, Mastercard stock has fallen around 20% from its April records. The big decline had fallen, nearly 20% from its April records, with a big decline coming from mid-November until the early part of December. Since then, however, since December 1st, the stock has surged 18%. The move helped it soar back above its 50-day moving average, and it's just now above its 200-day moving average after the company in the stock experienced what some traders call the death cross back at the end of September. The stock is still not overbought despite that huge 18% jump since the early part of December in terms of RSI levels, and it's still trading 18% below its current Zacks consensus price target. So some solid upside potential there in the near term and obviously the long term as well. We should also note that 18 of the 23 brokerage recommendations that Zacks has are strong buys with nothing below a hold for Mastercard. That said, based on some mixed earning estimate revisions, Mastercard currently lands a Zacks rank number 3 hold, and overall the stock has climbed over 250% in the past 5 years. This helps it blow away its industry's average of about 75%, and the S&P 500's 125% climb. The recent downturn has also readjusted its valuation, with it trading over 20% below its year-long highs at around 34.6 times forward 12-month earnings. This also represents solid value compared to where it was trading right before the initial COVID sell-off. So it's trading below the 37 times forward earnings it was trading right before the COVID sell-off. So some value appearing back in there. And all in all, investors might want to consider buying Mastercard for its ability to continue to adapt in the digital payments world, which is set to boom for years and years to come as less and less people, both in the United States and beyond, rely less and less on cash in general. And as we mentioned, they're really making waves in some of the modern new age payment spaces, from cryptocurrency to buy now, pay later. And now we're going to move on to another stock who's been far more hard hit than even Mastercard, and it has yet to bounce back in a big way. So you could pick up this stock for even more of a discount, and that is Roku, which trades under the ticker ROKU, which is also just its name in general. So Wall Street continued to sell Roku following its Q3 earnings release in early November, and this was part of a much longer and larger decline from its summer records. The streaming TV firm provided lower than projected guidance for the holiday quarter and posted slower account growth in Q3. Roku management noted at the time that the ongoing supply chain setbacks were going to disrupt the overall connected TV sales in the U.S. That said, Roku pulled in 1.3 million new active accounts, which was slightly less than what Wall Street was calling for, to lift its total active users to about 56.4 million. Some of the setbacks also, though, are expected to continue into 2022 as U.S. TV sales in Q3 fell below their pre-COVID levels. So this is just supply chain bottlenecks really impacting their connected TV space. That said, near-term setbacks aside, it posted blowout quarterly results still in Q3 with its adjusted earnings up from 9 cents a share in the year-ago period to 48 cents per share. Meanwhile, its revenue climbed 51%. The firm is also due for a comeback considering that its player space, which includes those streaming TV devices and those connected TV sales, account for far less of its business than these days. Roku now makes most of its money from its booming digital ad unit that enables companies to buy targeted ads to promote their streaming movies, shows, platforms, or whatever else they're selling. It could just be something totally outside of the streaming space, entertainment space. In fact, its ad-heavy platform revenue soared 82% in Q3 to account for over 85% of total sales. So the company was able to grow 51% on the top line, even though its player segment actually fell 26% from the year-ago period. Roku ramped up its spending to roll out more content, including far more original programming on its own ad-based Roku channel. Plus, it's expanding its international reach far outside of the US and Canada. And perhaps most importantly, ad dollars are simply pouring into streaming, and Roku is not being really impacted as much by some broader privacy concerns that have hit other digital advertising players, specifically on smartphones, specifically iOS, Apple devices. So with this in mind, Zacks estimates call for Roku's 2021 revenue to surge 58% to $2.8 billion. Sales are then projected to climb another 39% in 2022 to reach about $3.9 billion. This would see it add over $1 billion to the top line in back-to-back years. So this year it's going to add $1 billion, and then next year it's supposed to add another, even slightly over $1 billion, and extend its streak of roughly 40 to 60% revenue growth to 5 years, which is really highly impressive. Plus, it's projected to swing from an adjusted loss of 14 cents per share last year all the way up to $1.55 per share. Some of the negativity surrounding its last release also came in the back of its 2022 earnings estimate, which did slip from an expected $1.77 per share to around $1.62 per share as it faces that margin crunch in its player unit and some other broader headwinds. But these have improved slightly since that initial post-earnings release downturn in its revisions. Plus, it's destroyed our bottom line estimates by an average of 650% in the trailing 4 periods. This includes a 700% beat last period, as we alluded to earlier. That said, Roku is a Zacks rank number 3 hold at the moment, alongside A grades for growth and momentum in our style score system. And despite that post-earnings drop and the broader pullback from its highs, Wall Street remains extremely bullish on the stock, with 17 of the 22 brokerage recommendations Zacks has at strong buys, with only 2 below a hold. So overall, Roku shares have fallen around 50% from their highs earlier this year. It has popped back a bit recently, though it's remained rather volatile in the month of December. It was up around 3% through morning trading on Tuesday, and it has surged out of oversold RSI territory earlier this month to right around neutral. That said, Roku is currently attempting to return to its 50-day moving average. And with all of this in mind, the stock was one of those beaten down huge growth names of the last year and a half plus that has been completely recalibrated because Roku is still up 670% in the last 3 years. Overall, Roku is trading near year-long lows also in terms of forward sales, given this huge downturn. So it's trading at about 7.8 times forward sales, which marks a 70% discount to its highs over the last year and 45% value compared to its median. And it's trading below the 9 times forward sales that it was trading at right before the initial pandemic sell-off. So like Mastercard, its valuation is now back below levels it was before the pandemic, and then obviously before it went on massive runs that kind of got things a little out of whack amid that initial bounce back. And its current $395 a share Zacks consensus price target marks about 70% upside to its current levels. Therefore, investors with longer term horizons might want to take a chance on this pure play streaming TV stock that stands to benefit from the growth of the entire connected TV world and streaming TV world that has more and more ad dollars that once were going to linear TV, diving into streaming, and Roku is able to capture a large chunk of that market, a large and growing chunk of that market. So now we're going to move on to another stock that might be considered buying now for a comeback in the early part of 2022 and as a longer term hold. That is FedEx, which trades in the ticker FDX. The company is likely prepared to grow for years and years to come, and the global delivery firms already expanded its reach within e-commerce to help it soar during the pandemic. That said, the stock became a victim of its own success, and it faced substantial near-term headwinds in the form of rising labor costs and supply chain bottlenecks. But before we get into some of the near-term concerns that have also subdued recently, let's just quickly do an overview of FedEx. So FedEx, over the last several years, cut ties with Amazon, modernized its automation efforts, invested heavily in optimizing its last mile residential delivery, so that key e-commerce growth. And as we mentioned, this is all in the name of getting more market share in that booming e-commerce world. The firm does remain committed to its business-to-business segment, but e-commerce is where a lot of its growth is going to come from. The global shipping powerhouse pulled in about $70 billion in FY 2020. The company's e-commerce efforts then paid off in a big way during the pandemic, with its 2021 revenue up 21% to $84 billion. That was the period ended on May 31st. So despite the broader and overall growth of e-commerce and its success within that during the coronavirus, FedEx in the first quarter said that the tight labor market added $450 million to its costs in the form of higher wages, increased overtime, and other expenses. Executives at the time also said that supply chain setbacks had lower demand for shipping, with digital sales even taking a hit as more shoppers headed to stores or picked up digital orders themselves. FedEx consensus earnings estimates fell after that September report. Luckily, the company beat our Q2 FY 2022 estimates on December 16th and raised its FY 2022 guidance. This came as investors now are no longer really worried that the labor inflation and the impact on its profit margins are going to crush or really impact its bottom line. So it seemed that they were a little nervous that things were going to get really out of control in terms of higher costs in the first quarter, which they reported in September, but its recent results in mid-December really made people far more sanguine about their near-term prospects in terms of costs. So its operating income climbed 9% during the quarter to about $1.6 billion. And since its report, its FY 2022 and FY 2023 earnings estimates have trended completely upwards, with 9 estimates higher in the last 30 days for 2022 and 7 estimates higher versus 0 downward estimates since that mid-December report. This positivity helps FedEx land a Zacks number 2 buy at the moment. So overall, we're now calling for 11% revenue growth this year, all the way up to $93 billion, and then we're calling for another 4% growth next year. So some solid continuation of top line growth for FedEx. And we're calling for 14% adjusted earnings growth this year, and then another 12% adjusted earnings growth next year. So we're seeing the margin squeeze not really showing up as much as people were expecting, which is why the stock has regain some momentum. So FedEx also grabs A grades for value and momentum and a B for growth in a star score system. The company also recently announced that it accelerated its share repurchase program with its 1.17% dividend yield, so roughly 1.2% dividend yield, matching the S&P 500 average. We should also note that its transportation, air, freight, and cargo industry sits in the top 10% of over 250 Zacks industries. That said, the stock is down 2% in the last year overall, but it's up 70% in the last 2 years and around 40% in the past 5 years. And at around $255 a share, it trades 25% below its current Zacks consensus price target of around $321 per share, so offering big upside. And then, like all 3 of the stocks on this list, FedEx is trading at solid value compared to where it was before the initial COVID sell-off. So it's trading at around 11.6 times forward 12-month earnings. which marks a huge discount to its median over the last year and a huge discount to its highs. At one point in the early or after its huge initial pandemic surge, it was trading at around 22.5 times forward 12-month earnings. It's now at 11.6. It's, as we mentioned, it was trading at around 13 times forward earnings before the pandemic. So some solid valuation. We should also note that 12 of the 16 brokerage recommendations that Zacks has for FedEx are strong buys. So it's certainly worth considering FedEx as we head into the new year, as a both longer-term play for e-commerce and a near-term play for continued bounce back, with the stock up about 7% in the last month and then receiving some solid post-earnings positivity. So all in all, these are three stocks that might be worth considering as both near-term plays for the early days of 2022 and as longer-term holds, given their ability to grow within completely different industries that are set to expand for years and years to come. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.